The stock market may sound complicated at first, but the main ideas are actually pretty simple once you break them down. A stock is a small piece of a company. When you buy a stock, you become a part owner of that business. So if the company grows and becomes more valuable, your investment can grow too. People buy and sell stocks on something called a stock exchange. Think of it like a giant marketplace where investors trade pieces of companies every day. When most stock prices are rising, it's called a bull market. When prices are mostly falling, it's called a bear market. Some stocks move very quickly up and down. That movement is called volatility. High volatility can create big opportunities, but also big risks. Most investors don't put all their money into one company. Instead, they build a portfolio, which is simply a collection of different investments. Some companies also pay dividends. These are small payments given to shareholders as a reward for owning the stock. There are many different ways to participate in the market. Some people become traders. Trading focuses on making profits from short-term price movements. Traders may buy and sell stocks within hours, days, or weeks. They often study charts and patterns to try to predict what prices might do next. This method is called technical analysis. Technical analysts focus mostly on price movement, trends, and market psychology. Other people prefer investing. Investors usually buy strong companies and hold them for many years. Instead of focusing on short-term price changes, they focus on the company itself. They study things like profits, products, leadership, competition, and future growth. This is called fundamental analysis. Many investors also use ETFs and index funds. These are baskets of many different stocks grouped together. Instead of buying one company, you can invest in hundreds of companies at once. One famous example is the S&P 500, which tracks many of the biggest companies in the United States. Stock prices move because of supply and demand. If more people want to buy a stock, the price usually goes up. If more people want to sell it, the price usually goes down. There are also advanced and risky strategies in the market. For example, shorting means betting that a stock will go down in price. Investors borrow shares, sell them, and hope to buy them back later at a lower price. But this strategy is dangerous because losses can become very large. Another risky tool is leverage, which means borrowing money to invest more. Leverage can increase profits, but it can also increase losses very quickly. One of the most important concepts in investing is compound interest. This means your money earns profits, and then those profits also start earning profits. Over a long period of time, this can create powerful growth. Another popular strategy is dollar cost averaging. This means investing a fixed amount of money regularly, no matter what the market is doing. It helps reduce emotional decisions and lowers the impact of volatility. The stock market is full of opportunities, but it also comes with risks. Prices can rise quickly, but they can also fall unexpectedly. That's why successful investors focus on patience, discipline, learning, and long-term thinking instead of trying to get rich overnight. At the end of the day, the stock market is simply a tool. If you understand how it works and use it wisely, it can help you slowly build wealth over time.